Alrighty guys, welcome back to another video, and today I'm going to be going over how to trade prop firms. So if you're new to trading and you don't know the prop firm industry, so prop firms are technically a thing that you can trade without trading your actual capital. So you can use these prop firms to actually make a decent amount of money. So I'm going to be going over how I trade my prop firms, how I manage my evals, how I manage my fundeds. And this is how a lot of people actually manage their funded. So without further ado, let's hop right into this. So first off, we're going to just be focusing on the eval section first because if you're a new trader, a lot of traders typically spend a lot of time on the evaluations and they take it more personal than they actually intend and they actually need. So typically we're going to be talking about Lucid 50K evaluations. So these typically go around $70 to $100 per evaluation. So that means if you want to buy an evaluation, you're going to have to spend that your money in that sort of range, so 70 to 100 bucks. And the rules for these evaluations are your profit goal needs, so you got to make $3,000 to pass the account before you lose $2,000. So if you go and lose $2,000, your account is blown and you're going to have to buy new evaluations or whatever you do. There's also a 50% consistency rule. So this tends to get a lot of traders, at least beginner traders, because they shoot for the $3,000 profit goal and they don't know there's a 50% consistency rule. So what does a consistency rule mean? So since this is 50% consistency rule and you have a $3,000 profit target, that means you need to make $1,500 a day in order to meet that 50% consistency rule. So one day you need to make 1.5 thousand. The second day or another day after, you need to make 1.5 thousand. So that equals up to 3,000, also meeting the balance of your 50% consistency rule. And so how do I go along trading these evaluations? A lot of beginner traders de-risk. They only risk $100, so they're spending months on their evaluations. And this is not how you should be going upon them. Prop firms are a return on investment industry. So what do I mean by return on investment? So you're going to spend money in order to make money. So if I spend a set of evals, which would be 5, so that would be $100 for 5. So if I spent $500, my return on investment, if I pass the accounts, get a payout, would be almost $10,000 if I go for max payout. So prop firms is an ROI game, and you got to put risk on the table, especially on your evaluation. So how I go about this, I risk $750 to make 1.5K. I may risk $1,000 if I'm pushing it, but I want to give myself some chances to actually pass the account. So I usually typically risk $750 to make 1,500. And I go about these heavy. So if I blow the account, I'm just okay. I'm gonna go on to the next. I'm not going to hold emotions with these because I know it's an ROI game. So after you pass your evaluations, after the 2 days of 1,500, you pass the eval and you move to funded. So what do I mean by you move to funded? So now you're in the funded stage. Now this is where it gets real. Typically people go on their funded and blow it the next day. But I'm going to go over how you can trade, and there's different types of ways to trade your funded. So a funded account has a different set of rules than the eval. So in order to take a payout, you need 5 winning days of $150. So that means if you win 5 winning trades in a row every day and you make over $150, you can request half of your balance. And it's the same thing as an eval. You cannot lose $2,000. If you do, you blow the account. So there's 2 ways to play the funded rule. And a lot of people play them in different ways. So like a lot of traders will play it more safe. A lot of traders will play more risky. So let's go over the risky side of playing this evaluation. So on the first day you get your evaluations, you can typically risk 1,000 to 2,000, which would be your whole account, to build buffer to give you max payout. There's a big chance that you're going to blow your account if you lose a trade, because then you're going to be in the hole and you're going to have to dig yourself out. So this is why it's risky, because it's high risk, high reward. You either win the trade, you can get max payout and you can just target winning days, or you can play it safe, which would be risking around $250 to $500 per trade. So this is going to give you more opportunity to actually keep your funded account for a long period of time. So if you risked $250 and you lost 5 in a row, you would still have your funded account. You still would you would be in drawdown, but you'd still have it rather than the risky side. So a lot of traders play it safe, especially if you have a decent amount of accounts. Traders will go with the risk off. They would like to play it safe, so they target the winning days, because if you have 15 funded accounts, you can still manage to make more than if you went completely risk on with this. So how I trade my funded accounts, it depends. If I see a really good setup, I would typically add more risk. But if it's a bad PA, bad price action, bad market conditions, I would typically go and de-risk to target more of those winning days rather than having a big, massive day to actually build buffer. But my goal is to build buffer and actually play. So I kind of play both sides here, not just the big. So like, take this. You have good market conditions, you have bad market conditions. You do not want to be risking $1,000 to $2,000 on bad market conditions. You got to realize as traders that you want to preserve your capital, and you got to protect your capital as long as you can. And once you realize what set of market conditions we are, do we have an A++ setup? That's when you bang. You risk heavy, you jump in, and then that's when you actually build a decent amount of buffer. But you also got to trust your model. If you go in drawdown, you lose. It's a part of the game. Losing is part of a game. So, however, this is your personality. So if you are a risky trader and you don't mind putting on more risk, then go with the risky side. If you are a safer trader and you don't like to go deep in drawdown because that gets you emotional, then definitely go with the safer side. Both sides are definitely profitable. It's just people play them in different ways. So this was honestly a pretty quick video, but this was a very good video. If you were new to prop firms, you don't know what evals are, you don't know what funders are, this was a guide on how to navigate through the prop firm industry. So if you have any questions, don't be afraid to leave a comment. I will go and answer your questions because I know prop firms can be confusing, and I'm just trying to clear as much stuff as I can in this video. So this is pretty much the end of the video. This was going over the Lucid 50K evaluations. So that's the set of rules, that's the winning days. So this is the end of the video. Please like and subscribe if you like what you're seeing, and I'll see you all in the next one.